There are many avenues one can take in life in order to build their fortune. Some believe that hard work and sheer determination wins at the end of the day. Others believe it is working smarter, not harder, that is the best way to amass a fortune. Well, I'm here today to tell you that, like most things in life, the answer lies somewhere in between. Hello, and welcome to For the Sake of Curiosity. My name is Tommy, and in this video, I'm going to go over what I believe is the middle ground between these two aforementioned ideals: investing. I know this topic can be a bit maddening for some people to wrap their heads around, and believe me, I still have a hard time grasping the finer points of investing. I'm going to try my best to explain everything in as easy as a way as possible. Before we get started, I do have to make this disclaimer. By no means am I a financial expert. This video is for educational and informative purposes only. Don't sue me, bro. Allegedly, all that good stuff. I am some dude on YouTube after all. Before we get into the meat and potatoes of this video, I'd like to bring your attention to some numbers. According to the FDIC, average interest rates for high-interest savings accounts equals about 0.05% annual percentage yield. That doesn't sound like a viable way to amass a fortune or to fund your retirement. The numbers for CDs, or certificates of deposit, don't look that great either. The average return for a one-year CD is about 0.19%, or for a 5-year, it's about 0.33%. Again, these numbers don't really sound like a good way to retire early or at all. But Tommy, my grandpappy said that the key to financial success was to hold US Treasury Bonds. Well, I'm sure your pappy meant well when he told you this. However, the numbers sing a very different tune. The average for US Treasury Bonds is about 1.625% for a 30-year or 1.125% for a 10-year bond. You may be asking yourself, how the hell am I supposed to retire off investments if even bonds don't provide that much in value? And honestly, that's the question I first had before I invested too. This next number is what changed the entire game for me. The average for the S&P 500 between the years of 1957 and 2018 was an average of an 8% return. Now we're getting somewhere. In order to tackle investing properly, we need to first define some common terms used when discussing finances. Investing is committing money in order to earn a potential financial return. This financial return might be from increased value of the shareholding, a dividend payout from quarterly share profits, rental income, and/or small business profits. I won't go into detail about the more complex investing options out there, such as crypto, real estate, margin trading, or swing trading, as that goes beyond the scope of this video. Comment down below if you'd like to see me take a deep dive on some or all of these topics. Bonds are loans that a company must pay back. The primary disadvantage of issuing bonds compared with issuing stock from a company's perspective is that the company must repay this money with interest. On the other hand, the business doesn't have to relinquish ownership when it borrows money. Stocks are shares of ownership in a company. Unlike bonds, the money that the company raises through a stock offering isn't paid back because it's not a loan. When the investing public buys a stock, these outside investors continue to hold or trade. A dividend is the distribution of some of the company's earnings to a class of its shareholders as determined by the company's board of directors. Dividends are payments made by publicly listed companies as a reward to investors for putting their money into the venture. Announcements of dividend payouts are generally accompanied by a proportional increase or decrease in a company's stock price. An initial public offering, or IPO, refers to the process of offering shares of a private corporation to the public in a new stock issuance. Companies must meet requirements by exchanges and the Securities and Exchange Commission, or SEC, to hold an initial public offering. IPOs provide companies with an opportunity to obtain capital by offering shares through the primary market. Companies hire investment banks to market, gauge demand, set the IPO price and date, and more. An IPO can be seen as an exit strategy for the company's founders and early investors, realizing the full profit from their private investment. A brokerage account is an arrangement in which an investor deposits money with a licensed brokerage firm who then trades on behalf of the customer. Although brokerage firms execute the orders, the asset belongs to the investors, who typically must claim as taxable income any capital gains incurred from the account. Some examples of brokerages are TD Ameritrade, Fidelity, Vanguard, and WEBULL. If you use the link in the description, we can both get 2 free stocks when you sign up for an account and deposit $100 or more. A Roth IRA is an individual retirement account that allows qualified withdrawals on a tax-free basis provided certain conditions are satisfied. A Roth IRA is a special retirement account where you can pay taxes on money going into your account, and then all future withdrawals are tax-free. Roth IRAs are best when you think your taxes will be higher in retirement than they are right now. You cannot contribute to a Roth IRA if you make too much money. As of 2021, the limit for singles is $140,000. For married couples, the limit is $208,000. The amount you can contribute changes periodically. As of 2021, the contribution limit is $6,000 a year unless you are 50 or older, in which case you can deposit up to $7,000. Almost all brokerage firms, both physical and online, offer a Roth IRA, so do most banks and investment companies. A traditional IRA allows individuals to direct pre-tax income towards investments that can grow tax-deferred. Traditional IRAs allow individuals to contribute pre-tax dollars to a retirement account where investments grow tax-deferred until withdrawal upon retirement. Upon retirement, withdrawals are taxed at the IRA owner's current income tax rate. Capital gains or taxes on dividends are not assessed. Contribution limits exist, much like they do for the Roth IRA. As of 2021, $6,000 for anybody under the age of 50 or $7,000 for those 50 and older. You are also required to make a minimum distribution, and it must begin by age 71. A 401k plan is a tax-advantaged, defined contribution retirement account offered by many employers to their employees. A 401k plan is a company-sponsored retirement account that employees can contribute to. Employers may also make matching contributions. There are 2 basic types of 401ks, both traditional and a Roth, which differ primarily in how they're taxed. In a traditional 401k, employee contributions reduce their income taxes for the year they are made, but their withdrawals are taxed. With the Roth, employees make contributions with post-taxed income and can make withdrawals tax-free. Now, there are a number of strategies that people have derived with all kinds of justifications as to why they work with their system. Some folks, the thought of risking money in the stock market is met with the same ire like that of gambling. And to be fair, they're not wrong. There are no guarantees that a company doing well today cannot go bankrupt and lose value in a matter of months. Here I'm going to give you 3 quick tips that really helped me keep a level head when I first started investing. Number 1, invest in companies you know or have an understanding of what they do. A great quote to sum this up is from Renee Rivkin. When buying shares, ask yourself, would you buy the whole company? If the answer is no, then put your money into a different company. The second tip I have for you is to keep your emotions in check. From day to day, the market will fluctuate, and that's completely normal. Remember, investing is a long game, and any dips you see today may only be temporary. The third tip I have for you is to invest often and do not try to time the market. As Warren Buffett once said, it is time in the market, not timing the market. And that was a beginner's guide to investing in 2021. I hope you enjoyed the video and learned a little something about investing today. If you did, please be so kind as to gently tap that like button in order to help the channel grow and please that almighty algorithm. If you haven't subscribed already, go ahead and do so and turn on the bell notification icon so that way you're notified when a new video is uploaded. Thank you so much, and I hope to see you again in the next video.